Well, good afternoon, everybody, and welcome to our May monthly market insights. Spring has sprung. It's finally getting warm here in the Northeast, which is great. But before we kick off our recording, let's hear from the legal team. Okay, good stuff. Well, let's kick it off the way we normally do and do a recap of our April session, and then we'll kind of jump in. A lot has occurred here in the last 30 days, as is typical, but we certainly had a lot of gyrations and volatility in the market. So, Rich and Gavin, why don't you get us caught up on what's happened the past 30 days?
Yeah, sure. One call out that we had in April was that we thought consensus estimates on growth had, come down a bit more towards where we were. The development as we start May and the call out this month is that it's pretty apparent now that they overshot. And so, meaning they took down their growth estimates too far. And I think Rich will probably touch on more of this, but the conviction score, what we kind of use to look out ahead, is very low. So there's not a lot of clarity. And I think some of this news, some of these headlines that, Todd, I know we've talked about it a ton, kind of caught the market off guard with those very, very conservative growth numbers. And we're seeing kind of this pop in markets. And so I think Rich will probably get into more of that, but that's kind of to set the stage from last month.
If you go back a couple sessions, we've been saying, quad 3, which is growth slowing, inflation accelerating, is kind of the probable path over the next couple of quarters. Post Liberation Day, GDP growth estimates for the street came down too much. And that's setting up, which was called out in the most recent issue of Market Insights, the early May issue, that if they overshot estimates on the downside, chances are they're going to be taking their estimates back up. Mm-hmm. If they're taking their estimates up and inflation heats up, that could give kind of a quad 2 flavor to things. And it looks like that may be, transpiring in markets. We're seeing behavior across our risk matrix. That's the 42 global markets all over the world, where we try to characterize the current behavior in terms of, is it most characteristic of quad 1, 2, 3, or 4? And it looks like quad 2 is going to be, kind of the leading regime for a while, or at least on a transitory basis. So in some of our portfolios where we've taken equity exposure down, we're taking it up incrementally. We're not, making any big changes there, but it's happening coincident with progress on the tax bill. And I think the House is going to try to have something by Memorial Day. Then it goes to the Senate. You probably get, some kind of a combination between the two plans. But if you kind of put together the main, factors so far this year, obviously tariffs have been big, big headline. But the behavior since then is the administration has backed off them. So next time he talks tough on tariffs, I think markets are going to look past that and say, well, he just does that, but he's going to backtrack. So, if you're looking at policy uncertainty on tariffs, policy uncertainty has declined. We're getting more clarity on the tax bill. There are, probably 10 or so changes that are worth highlighting in terms of, no tax on tips, higher deduction, standard deduction for seniors, things like that. If you go through those 10 and say, what actually is positive for economic growth, I can only see 4 things. If you build a factory here between 2025 and 2029, and it goes in service by 2030 or 32, 33, whatever, you get a deduction on that. It's like, all right, well, that is going to help business investment, but why limit it to factories? What if somebody has a factory and wants to upgrade all their equipment? Why should they not get a tax break? So it's government engineering basically, and I don't. There certainly are pro-growth elements to it, but it completely misses the big picture. This would be an opportunity to radically change the tax code, which people have been talking about, for decades. And if we had a tax code that exempted all exports, taxed imports exactly the same as domestic goods, and exempted investment, we could grow at 4% a year for a decade. But that's not the path. This is, more of a government engineered tax break, but you're getting more clarity on that. You're getting less actual spending reductions. So when you add it up, there are going to be less spending reductions. There's going to be less money raised through tariffs. The tax bill is probably going to end up bigger than what was expected at the beginning of the year. I don't like the way Washington scores, tax cuts. They assume everything is static. And, if you change a tax rate, that nobody out there is going to change their behavior, which is silly, but that's how they have to get it passed. The net impact of that is going to be most likely the Treasury is going to have more debt to sell than the original plan. And that goes back to a theme that we've been talking about now for, quite a while. Are there enough Treasury buyers out there to buy not just the bonds and notes to finance a deficit, but there's an unusually large, it may be a record, I don't know that for sure, but it's like $11 trillion of treasuries comes due in the next 12 months. So this quad two, transitory quad two could last for a while. And chances are the thing that starts to derail it is when the Treasury has to hit the market, when the debt ceiling is lifted and Treasury has to hit the market to refill their bank account, pay off the Fed, finance a deficit, and roll over an unusually large amount of bonds, bills, and notes. So that risk factor has gotten larger. The policy risk is decreased, but the Treasury financing risk, I think, has gotten larger.
Well, that's a lot going on, and that I didn't even think about the new tax bill that's kind of just come to the forefront here this week or late last week. So the administration has done a number of things in a very quick fashion and quick pace, and that creates jitters and creates some uncertainty. One of the things I wanted to ask you about is one asset class or one area that has performed really well are international equities. How do you see that trade carrying out, and what would be the impact of what happens here domestically, and how will that perhaps impact opportunities overseas or investing in overseas, which has really not been a good place to be, the past 3, 4, 5, 6 years?
Yeah, well, that's a good point. And in fact, we have been recently adding, I'll call it rest of the world exposure. And I think it's more than just, what's going on currently. I think we've talked in prior sessions about the net international investment deficit, which is a mouthful, but it's basically a measurement that says how much U.S. assets are owned by foreigners minus how much foreign assets are owned by Americans. If you net the two together, it's ballpark 25 trillion that foreigners own more U.S. assets than we own. So it's a big number. It's a material number. And if you go through kind of the bookkeeping of trade, the trade deficit is the same thing as a capital surplus, right? That would mean I'm buying goods from you, Todd. So goods are coming this way, but money's going that way. And that always has to balance. If I buy something off you for $500, you're down $500 in goods, but you're up $500 in money. And it's the same thing, but reversed on my end. So the capital surplus finds its way back into US dollar denominated assets.
Mm-hmm.
It provides a subsidy for treasury securities because that's the number one asset that foreigners buy. It also has boosted the stock market. So if you track this, it's doubled in the last, I want to say 5 years. So picture going from $12 trillion net international investment deficit, and then having another $12 trillion come in the dollar denominated assets over the last 5 years. That's been a major factor why US has outperformed international. So let's just say the administration is successful shrinking every trade deficit that we have. Hypothetically, that's also going to shrink the capital surplus that we have.
Yeah.
And it may even cause reversal. So you have this $25 trillion of US assets owned by foreigners, that if that gets repatriated back to, home countries, that's going to create net flows out of US assets.
Right.
It's kind of ironic that, we have this America First agenda, and the impact from a market standpoint could mean that rest of the world assets outperform US assets for a number of years. I wouldn't be surprised once this starts that this could be something that has, some fairly long life to it. That at the very least is going to be a tailwind for foreign assets and a headwind for US assets.
Well, again, a lot has occurred since the new administration has taken place. On top of all the tariffs, a new tax bill, just a boatload of items that, and as we all know, markets tend to get sometimes a little bit jittery when there's not a clear path or if there is some ambiguity in markets. So I guess we shall see. And as we head into the summer months, right? The old saying, what's the old saying, Rich, about the markets go away in May, right? Or
yeah,
right?
Yeah.
So,
well, I mean, along those lines, a friend sent a breakdown of, and I forget the title. I probably should, give the guy due credit for it, but it's something like this: the 7 steps of maximum pressure. And he went through, number one, make a totally unreasonable demand. And then when people doubt you, then double down on it.
right.
And they're applying it to Trump. So what they're saying is that we're at stage 4 now, where now you're sitting down, breaking bread, and you're going to negotiate. And his point was, step 5, you got to watch out for, because step 5 is you turn back into a madman and you start turning tables over. So that could be the sell in May and go away. In that, if anybody thinks that the trade deal, that's being negotiated with China is going to be the end of it, they're going to walk out, shake hands, we're going to get a deal, and that's going to be it. That's probably not how.
Not good, right? That's not how it'll play. So.
Yep, there's going to be another, punch to the jaw before all this is over, most likely.
Right. Another round, as they say. So, well, we shall see. Well, hey, thanks, guys, and we'll reconvene in June and see how things play out.
All right, sounds good.
All right.
Okay.
Have a good day, Todd.
Thanks.
Take
You
care.
too, guys. Bye-bye.